Hey, everybody. Welcome to a new episode of the Next Matters Most podcast, where we talk about the future of business, innovation, and technology. In this episode, I'm talking with Gregg Bordes, partner and co-founder of Front Porch Capital. Front Porch is a VC firm based out of the Raleigh-Durham area of North Carolina that is working on something that I think is new and innovative, which is a hybrid model, meaning they invest not only directly into startups, but into other startup funds as well. The benefit to an investor is you can write one check into a smaller, newer fund, but get exposure to all of the areas and regions venture capital firms. So you increase your diversification. You can participate into many funds with the size and allocation of doing one fund, which I think helps many investors get off the sidelines and then start to participate into venture capital as an asset class. So they're working on something that I think is important to grow the pie of small business and innovation in our market, in our region, and in the world. So I'm very happy to be speaking with Gregg. Secondly, I'd like to update our sponsor roll call here. As you know, we've been bootstrapping this podcast with the help of our agency, or my agency, Smashing Boxes. We build software for startups. We're also going to shout out Smashing Boxes Ventures, which is a new venture building studio that we have spun off. Got it going, I think, in the early parts of COVID, so 2020, 2021. But here we are in 2022, really ready to hit the gas. We've got a couple of our portfolio companies getting ready to come out of sort of stealth mode, also known as just working on building stuff and not, focusing on announcements or press yet. And third, we are filming this in Durham Bottling Company, which is a co-working space in downtown Durham. So if you're in Durham, come check us out. We have free day passes. You can get, remote membership if you need to. You can get temporary memberships, part-time, full-time. We've got private offices. We've got plenty of conference rooms if people need to rent a conference room for a meeting for a day. And we have a event venue sort of adjoining us here. So a lot of our members hold their office work here. Board members or board meetings will happen in one of our conference rooms, and then they'll have their pitch day, demo day, gala, fundraiser in our event space. So it works well for many. We're located in the hub zone and an opportunity zone. So companies that are maybe considering raising funds using either of those mechanisms, we have some advantageous locations for that. And so thank you to those three groups that make this podcast possible. Enjoy the conversation.
This is Next Matters Most, a podcast on the future of business, innovation, and technology. And I'm your host, Nick Jordan. I'm here with Gregg Bordes. Did I say that right?
Bordes.
Okay, well, I knew it had a little to it. It wasn't just boards.
A little French to it.
A little something. Who is a person of many things. He does not just identify as a Front Porch Capital partner and investor, but that is one of his many things that we're going to hear about today. So, Gregg, welcome to the show. Maybe give us kind of your quick bio and elevator pitch on both yourself, because obviously I want to hear about everything and how you got to where you are, but then also, kind of getting into Front Porch Capital.
Yeah. So I'll give you kind of the quick 2-3 minute background on myself, as well as Front Porch. So, originally from Kentucky, southeastern part in the mountains, and went up to New York for undergrad, studied finance and economics. Honestly, what took me up there was I got into investing at a pretty young age, and wanted to move up to New York and pursue that career. I stayed in New York for most of the next 20 years, met my wife at NYU, and then worked at a number of investment firms in New York. Started in investment banking at Merrill Lynch, M&A, and worked at a couple of large private equity firms in New York, AEA Investors, which has been around for a long time, Stone Tower Capital, which is now part of Apollo. Went out to San Francisco for a couple of years, worked at a private equity / public equity hybrid fund, and got exposure more into kind of the public markets. My connection to the Triangle originally was business school. So I left San Francisco and moved down here. I guess that was 2010, and went to business school at Duke, which is actually where I met what is now my two partners at Front Porch, Nick and Shaw and Joe Mancini. I met them at business school, but after business school, my wife and I moved back up to New York. I joined a public equity fund, basically a hedge fund, became a partner there, decided I wanted to do something a little more entrepreneurial, and left there and joined a venture-backed data analytics startup called Yipit Data. Became head of research there, built out a large research team. We can talk, a little bit more about that business if you're interested. And then a few years ago, my wife and I, we've got 2 young kids. We had moved out to Westchester from the East Village, and after a couple of years of commuting, we're done with that, and decided to move back to North Carolina. We loved it down here when we were here for business school, and I'm originally from the South and wanted to head back down this way to raise my kids. And so we decided to move down here. I joined a large private family office, was investing out of that, more kind of growth equity, private equity, and then simultaneously setting up Front Porch Venture Partners, as I mentioned with Nick and Joe, starting, I guess, about 3 years ago. We formally launched the fund about 2.5 years ago. And, we're about to launch Fund 2. I stepped into Front Porch full-time last year, kind of in preparation of wrapping up Fund 1 and then to launch Fund 2. And so Front Porch, we're a hybrid venture capital firm where we invest in other venture capital firms across the Southeast, as well as directly into startups. If you think about it from what we're looking to offer investors, it's a more diversified approach to venture capital. So a typical venture fund that you invest in, will have exposure to typically somewhere between 10 and 20 startups, call it an average of 15. And, a check into Front Porch is exposure to 250 plus startups. And why we think this is important, at the end of the day, venture capital, or startups as an asset class is really a high volatility asset class. And you need to spread your exposure over a larger number of investments there to get kind of equivalent diversification that, call it, 14, 15 public stocks would provide. To get equivalent diversification, you need to spread it over the 250 plus startups. It's an asset class that works really well for large institutions that can write, 15, 20 checks to different funds and gain that exposure. It's tougher for individuals. It's tougher for family offices and even smaller institutions that are not necessarily going to write 15 to 20 different checks to different funds and get exposure to 250 plus. And so, we started Front Porch. Yeah, it's similar to a lot of startups, right? Like you're facing a problem yourself, and you start iterating through that and realize that a lot of other people are facing that problem. And, one thing leads to another, and you decide to attack it head on. And that's really kind of origin story for Nick and Joe and myself. We, all three of us, active kind of in the entrepreneur ecosystem, love the growth that comes out of that, the job growth, personal angel investors, friendly with a lot of venture capitalists. Each of us were talking to 3 different venture funds about writing a personal check, into their fund. And, we were getting close to making that decision. And, as we just talked about it amongst the 3 of us more and more, we were having that problem of, because the minimums of these funds are 250,000 plus. And making that kind of commitment into one fund, having exposure to, call it 15 startups, is a very concentrated bet. And, as I said, unless you're going to write multiple of those checks, we weren't in a place to write multiple of those checks. And so, the first iteration of this was Nick and Joe, myself, think, what if we just pool our own money, and at least we can invest across, the 3 of these. And then as we're doing some of these, one-off checks into startups, we could also put it in there and kind of broaden that. And as we were kind of kicking around that idea, we were just talking to other, other friends, other people I've invested alongside of, other people in the local business community. And we got a lot of a similar thought coming back to like, yeah, I would love to allocate money to venture capital. Like, I get it. Like, I get why institutions allocate 20 or upwards of 50% of their capital into that world. It's a long-term outperforming asset class, but like writing a $500,000 check into one fund and having exposure to 15 stocks or 15, startups. Like, that's a tough bet for me. And so we heard that enough to where, we started kicking around the idea of actually putting a fund together to attack the specific problem. And, really it's like the idea of like, bringing more capital into an undercapitalized region, which is the Southeast, from a venture capital perspective, historically and currently we're an undercapitalized region. So like bringing more capital into that, but also bringing more people into it, just people that wouldn't necessarily have exposure to venture capital or be like directly connected to it. Otherwise, bringing more, people into that, and just offering a product that's more appropriate, from a risk reward perspective for a lot of individuals, family offices, and smaller institutions. And so that's what we started working on, kicked that off about 2.5 years ago. So
that's awesome. I'd love to be like kind of chronological and linear even in the thought, but I wanted to skip ahead to a quick question. The like GPLP, whether you do it as a partnership or as kind of LLC, managing LLC, whatever, is there a restriction that like the 99 members, and because one of the things that you said that was actually really cool, which was something that I personally gravitated towards, was sort of the access component, right? It's sort of like, yeah, 250K is a big number for one fund. That amount or even less than that amount across multiple funds starts to make it much more accessible to others as they start to think about investing. But there's sort of the inverse, or like you're disincentivized to do that if you're like, well, I need my fund to be bigger and I've only got unlimited. Can you do that? Limit's still in place, and can you raise like a fund two and then like a sidecar fund two, where you can like consistently get 99 smaller checks in there so you can increase the pie of investors?
Right. Yeah. So, well, first on the LP/LLC question, that's two different ways to set up a fund. But from the perspective of the 99 investor rule, it's the same. So if you are, effectively a private investment fund, and so that would be a private equity fund or a venture capital fund, you fall in that kind of same world of your maximum is 99 investors. And so that's why venture capital funds have minimums, right? If you're only allowed to have 99 investors and you're trying to raise X amount of money, there's specific math there. And so, in our model of a hybrid fund, it doesn't fix that problem, because at the end of the day, we're limited to 99 investors, but it helps in a way of, instead of being able to invest in one fund, someone can invest in 15 funds through us, right? And so it moves down, if it takes $5 million to get proper diversification in venture capital, if you're going to, if you need exposure to 15 different funds to get that, like the amount of money that you need to get proper diversification in venture capital becomes much smaller investing in a fund like us, where, one check into us gets you that similar exposure. So it doesn't fix. And to the question of kind of like parallel funds, there's a lot of very specific rules that what you can't do. Like let's say we were, and I'm no attorney, so I've learned this or been taught this, but let's say we're gonna in our fund have 15 fund investments and 20 startup investments. We cannot set up two different entities. And each of them have 99 investors and invest in those same securities. They're like, there's a whole set of rules of like basically not allowing you to do that, because like, you're circumventing the 99 investor rule, and, the SEC understands that. And so now, but what you can do is, we could raise a fund now, fill it up with 99 investors, raise a fund next year that's going to have a different collection of funds and startups and whatever in them. And there's probably some, room in between those two things, but you cannot have like for like, call it Front Porch Fund 2A and Front Porch Fund 2B that have the same securities inside of it. You cannot do that under, the fund structure that we have.
Yep. That makes sense. And I'm sure it would make sense why that rule was set up. But, I guess it's working against the concept of, people being, okay with taking smaller numbers, like, which I think we should figure out. Maybe that's like via the rolling fund kind of structure where it's like
types of structures that don't have the same 99 investor limit, rolling funds being one of them, and a whole separate set of things. The issue, and we've looked into these as we, particularly kind of between Fund 1 and we're about to launch Fund 2 and thinking about if any of those make sense for us. And the biggest problem for what we're doing and using one of those alternative structures is the fund of funds component of our fund. Like we could do that on the direct side, but the fund of funds, like we're making long-term commitments to other funds. And so we can't have people rolling in and out of our investment quarter to quarter, like a rolling fund. We're making individual investment decisions, in us. I mean, and in fact, when you sign the docs, like when we sign the docs or anyone signs the docs to like subscribe to a venture fund, you make very specific things that you promise. And one of them is that you're not allowing your like investors to be like picking yes or no on each investment. And the reason is because if that is true, then those investors count against that fund's 99 investors. So there's just like that look-through mechanism. So like if you have to like do a certain number of things to not be considered, like for all of our investors to not count as a fund's investors. And so like we can't have a certain, percentage of our assets, over a certain percentage of our assets in one fund, because then it would just look like a look-through entity and then all of our investors count against their 99. And anyway, so a bunch of those different things. And one of them is in an investor, our investors being able to like say yes or no to investments that we're making.
Yep. Yeah, it's interesting. I mean, I think there's definitely kind of a big opportunity in figuring that out. And maybe it's not figuring it out in the current construct, just like we see some movement time and time again from, equity-based crowdfunding and ways to get around even just the accreditation or requirement, because I was going to say an accredited investor isn't as much as people sometimes think. It's a lot, but like you can be accredited and not be just being able to say, I'm going to commit to $350,000 for a fund. It's like, wait, you need like $1 million. I mean, it's more of something like primary home liquidity. It's like, well, I'm just going to go from 0 to 35% allocated to that. It's just a huge jump. And so it's like, there is a lot of people that have plenty of money that would love a $5,000 allocation, 5, 10, 15, 20, and then doing that a couple different times over. I think the Front Porch sort of vehicle maybe allows people to kind of like take some pressure off of like, I have to go out and do 4 or 5 instead of just like, because anything that's a big number is always scary, right? So like, I'm just going to buy one stock. Like you have to really believe in it. So it had just to grow the pie. And I've had, if people ask me, I think about, it's either a smaller fund that's newer that has a lower minimum, or it's like a local angel group where, like an alumni group, Duke's got one, UNC's got one in terms of the Triangle or Southeast. I'm sure a lot of the major colleges have them, where it's like you can kind of, it's almost they're just a group, a syndication group. So, they might have a minimum that they set and they can only take 99 people, but they're expected to do less of a check on a per deal, or the rolling fund. So how can people start to say, I want to put out 20, 30, 40K a year maybe, which is still a lot relative to, the general population. So maybe there needs to be ways for there to be less, but you'll start to see, well, again, I guess I don't want to mix, kind of metaphors here, but I guess if too much money goes in, then the returns might, regress towards the mean anyways. But, how do we start to see, kind of an exponential pot growth in terms of, funds invested? Because there's definitely there's a lot of smart money around here just because but it doesn't mean that they have the kind of interest or means into that kind of like very, large outsized allocation, mixed with the kind of combination of, chicken or the egg in the Southeast too, which funds are really just destroying it and creating big brands and big names. It's like, I don't know. And then they don't have access to go invest in Kleiner Perkins as somebody from, Raleigh-Durham, North Carolina. So,
there's a lot of things going on there, right? Like, one of just like, if you're making individual startup investments, at like $5,000-$10,000 pop, either through an angel group or syndicate or whatever, that, at the end of the day, that is a different thing than a broadly diversified portfolio, unless you're doing a ton of it. Like it is hard to invest in 250 startups. To go to AngelList, there's a bunch on there, but to actually like spend the time to go through those and make investment choices, like unless it's your job or you're willing to allocate a significant amount of personal time, like that's a tough thing to do. And then there's, and much ink has been spilled on this concept, but it's just like, there's also some question about bias of what ends up on those platforms versus what is being invested in by large VCs. Because I mean, as an entrepreneur, like it can be more painful to go through the small check, pulling together on a lot of the platforms. And so those with choices don't always, but often will go to the, a VC that they know or someone in the local market or a big name, and they'll get, several $1 million written to them in one conversation versus having to kind of chase it longer term. And so I think the jury is still a little bit out on like long-term returns on, some of the platforms. I'm a big fan of them, and I think it's awesome that they've kind of pushed it down into a larger group of people. But I do think it's a bit of an apples and oranges comparison of like putting money through that channel and trying to write 250 of those checks versus getting exposure, to like 15 top VCs. Like they're just seeing different deals and and professionally investing that money. And so, and I think we're kind of like a step in the right direction in being able to, broaden access to like multiple funds and big names and ones that you just wouldn't get into otherwise because of, minimum investment size or whatever. But obviously a lot more could be done there. I mean, there's something that's been kicked around for a long time, and it's recently gained more traction, in the political sphere. But from my understanding, it's not going to pass in this next Congress. But there was question of whether or not it was going to pass. But anyway, it was changing the 99 investor rule to 250 investors. And that would go a long way. I mean, essentially the math on a $20 million fund looks very different of what you have to have as a minimum if you can have 250 investors. And so, I strongly believe that should be changed to 250. Like I'm more on the neutral on the accredited investor knock, because some people want to scrap the accredited investor rule. A lot of people have said, I don't know if I have. I mean, it was put in place for a reason, right? Like you don't want people to tie up assets in long-term illiquid asset classes if they can't. Now, is the accredited investor rule like the best rule to ascertain that? Like, no, but like I haven't heard a lot of other ones that are better. So, and it's funny, it's gotten smaller over time, right? Like those numbers, those thresholds were set a long time ago. And I don't think they've changed much over time, whereas obviously the value of money has.
So it's naturally,
kind of like naturally, like moving down. But I do think there, likely needs to be some sort of threshold there, from a, either a wealth or income perspective. I'm definitely not saying it's perfect, and I understand people's criticism of that rule. But I do think it was put in from a good place.
And what's 99 investor rule? Like, where did that start from in terms of like the reason it is a good idea?
I won't even pretend to know that one. I've always like in my head figured it was something about just like fallout, like if something blows up, in one of these, it's like it limits its overall, overall fallout of that. But I really am not sure why they chose that number. And because what it falls from is like over certain numbers, you have to start being regulated by the SEC. And so like they just have chosen a certain like asset level of a fund and a number of investors because by the way, we could absolutely have 150 investors of a fund. Right. It's just, if we did, then we would be regulated in a very different way. And no one goes that path because it's so expensive and so onerous for this type of fund that just like, it's basically just capped it at 99 because no one's going to go above that. Once you do, it's a different thing. You're an investment advisor, and I don't know all of the rules of that, but it's a very different thing.
Yep. Well, it's interesting. Most of these, like all rules, regulations probably started from a good place and, have been followed closely, but just like investing in startups, everything is question everything. Right. And so I think in this case, what I love about Front Porch is kind of this access piece. And so kind of hand in hand is, keep lowering minimums and broadening how many people you can take on, which is sort of counter to the way the systems are are set up, the better you do, the higher the minimum will go because you have more interest. And which is great in so many ways that you're doing well and are going to do well. But like, I like that piece where I want more involvements. I want more participants, not just the same people doing the same funds. I mean, there could just be 99 people in a market. They just do all the funds and no one else will ever do them. And it's good if they get the money and subscription size they want in terms of funds and allocations, but I'd rather see a larger, kind of participation base, but we'll keep an eye on that. You keep lobbying your congressman.
That's why we ended up launching this, because we talked to so many people that were interested in getting involved in venture capital and saw it useful from multiple perspectives. Be it just an overall returns perspective of like outperforming asset class, great, but also like, I want to support new businesses that create job growth, like here in the Southeast. That's important to me, as well as like learning. It's amazing the number of our LPs that at least part of why they invested is just like they want to read about and learn about more of the startups, here locally, across North Carolina and across the Southeast. And it's a good opportunity for them to learn about those startups as well as those venture funds that we invest in. It's an easy way to kind of come up that learning curve and of understand that, because venture capital has gotten to be a larger and larger piece of the overall, the asset pie over time. But I think even more than that, it's like the piece of people's mind. Like, I think 10, 15 years ago, I don't think it was as commonly or as broadly understood, industry by like the average person in America. Whereas now it's like, it is, there's been so much exposure to it, over the last 20 years of just like the companies that have been venture backed and become public and become huge. And, and it's just like, there's been a public education of that. Whereas institutions have been investing in this for a long time. More of the average person like understands like, oh, this is an asset class that I could have money in. I just don't necessarily know how. And then the next step of those people that actually do know how, but they make that decision of like, man, it's tough for me to route a $500,000 check into one fund. Or I can, like I am an investor in this fund, but like, I also would like some more diversified exposure. I mean, that's also a common thing in terms of our limited partners. If it's, I always think about it as like my PA, like my stock account at Fidelity. It's like, I have an individual, stocks, right? But I also have ETFs and I have more money in my ETFs than I have in individual stocks. It's not an either or situation, right? Like you can do both. They're different risk rewards. And so for, quite a few of our, limited partners, like they have personal investments in a fund or three, but then you view us as a more diversified exposure,
sure,
the broader.
Yeah. And how, is this concept known? Obviously fund of funds has always been around, but in terms of like the hybrid VC, are a lot of people doing it? Very few? Where are you on that kind of spectrum of newness to the marketplace?
Yeah, it's, I don't think we invented anything here, but I'm not aware of anyone else doing it, focus on the Southeast. I think that there are a few firms in the Valley that have done this successfully for a long time. But I think even more so, it's like who has done this successfully is, for a long time are endowments. Like they come into funds and then they get, they get rights to be able to, make like double down, triple down on individual bets at startups. And they leverage their fund investments to get good exposure, on the direct investments. And I think from, endowments and some pensions and whatnot, that's kind of spread further over time. And so I think there's like, RIAs that do the same thing. They use fund investments to then get into direct investments, et cetera. But, I'm not aware of any other kind of like funds like us, at least in the Southeast, to where you kind of put one check in and have both sides of that.
Yep. That's great. That's my kind of experience or understanding as well, which, obviously, this isn't even necessarily a novel or brand new concept, but just being applied kind of in our region, which is, I think underserved a little bit from a capital perspective. But, who knows, maybe we just don't have as good of an idea or ideas. But
I spent 20 years in New York and also lived in San Francisco, and I see deal flow from both coasts. And, I think that you can take an equivalent management team with an equivalent concept at an equivalent stage, and the valuation that you see it here in the Southeast is significantly less than what you're seeing in New York or the Valley. And what that means to me, it's the lack of capital chasing that idea. I mean, that's what sets the price, right? And so until there's equilibrium on that pricing between those two, like, we are an undercapitalized region, like, by definition.
So do you see that as a risk as an investor? Because I see, and I've heard that pitch before, as a potential, like, LP. Obviously, I've on the operating startup side too. It's like bad for startups because you're like, oh man, my valuation is so low. And then from the investors, they're like, oh, this is great because we get, a much better deal because valuations are so low. But if you just zoom out from both perspectives, if you're competing with that same company, same stage, same team, but they just have 5 times more money, aren't you still just inherently at a disadvantage, even though it was a deal, because you just are undercapitalized for whenever that bump in the road happens or that downturn or something, you've got to pivot. It won't, you know what I mean? Like, it feels like that.
Actually, I know exactly what you're saying. And quite honestly, I think it cuts both ways. I think net, it's positive for investors, in this region, but that's not to say that there's not any negatives. I think if those startups had to stay in region forever, then it would probably be more even in terms of, like, positives and negatives. But the reality is like, if you're investing in seed and A around here, and as you grow up and get bigger, and then you actually need that money to compete, so you found product market fit and you need the big dollars, like, you can step out of region to get those bigger dollars, and then you're going head to head with those same Valley people. But, like, the entry points here are lower for the investor. I think there is something to be said also for not so much money sloshing around the system that bad ideas get funded. Whereas I think it's a much bigger risk, in the Valley, where it's not that hard to get funded. And because of that, you've got a bigger wipeout rate. And it's a noisier market there. And I think there's something to be said for a little bit of, like, discipline, even if it's forced discipline in the Southeast, because there's not as much capital, of, like, you've got to have a pretty good idea and a pretty good team to get funded around here. And so, like, that benefits the investor as well. Just like that dynamic. But it's not to say it doesn't, cut both ways, because if you get in trouble, around here, in the Southeast, like, there's fewer people out there to bail you out.
Sure.
But at the end of the day, those are not necessarily the ones that go off to create your returns anyway.
Sure. Well, where's the inflection point, right? Because if you're just perpetually underfunded or undervalued relative to your peers, eventually you're a less of a unicorn, or, and you IPO or whatever, your exit's lower, your IPO value is lower, your share price is lower. Like, but if, like, to your point, once you can get out of market, there might be some catching up. Where do you see that inflection point happening?
Yeah, I mean, I think it's going to be different for every business, like every type of business. But I mean, like, listen, it's like, I don't think anyone thinks that, Pindo is, like, being super undervalued because they're based here, right? Like, they grew out of that, and then they got, a real world, like a broader market valuation. And it's like, so it's somewhere on that continuum, right? Like, in the earlier stage stuff, it's, you're probably going to get less. But then once you get, easily once you get to growth equity, growth equity investors across the nation are like machines in terms of, like, reaching out to companies, to startups across the country. And, like, once you hit their criteria of, like, whatever ARR, or whatever metric that they're focused on, once you hit there, like, they don't care where you're based. Like, it's just like, you've hit that, from their perspective, product market fit, and, like, they can write you that check, and they're going to write it at the same valuation they would write somebody in the Valley. So
sure.
Once you get up, into the growth equity stage, I think it's same, completely. I think it can happen sooner for other people, depending on, depending on which market there is. It's going to be easier for, like, enterprise B2B SaaS players than some other ones, but, so it's going to be a little different on what market we're in.
Yeah. Well, and you're the fund manager, so obviously you can't really make promises. I'm just some guy asking questions. But like what I'm interpreting that is the promise I want to see fulfilled too, which is investing into startups in the Southeast is a good deal. And we should have more money, more capital attracted to this area so that more companies have, the fuel to add to their little spark. And that your outperformance will come in time, right? Maybe earlier, maybe not until growth equity, maybe a little bit later, but like that's kind of our arbitrage opportunity. I've been seeing arbitrage opportunity in investment pitch decks for a long time, but it just never really comes to fruition in definitely not in mass, because then everyone would know about it. But it's even arguably has not even, the funds here have just returned. Well, it's not even here. It's not personal to any of these funds, but they just kind of return. They're not overly outperforming other funds either. So but how can we find, by naming it though and saying, hey, we just have to get more companies to growth equity. And then that's not just the one thing. It's not binary, but further down the road is where we get that extra pop by being in earlier and at lower price points. So we've got to do whatever, as an ecosystem, then we've got to be thinking just like everybody beyond the seed, beyond the A round, where are the B rounds? How do we pipeline in more of the growth equity people? And how do we really rally behind the ones that could hit the growth equity spot? Whether that's right or wrong, it's actually an interesting thought. It's something to focus on. Okay, if people just get acquired or acqui-hired or soft landing or whatever, all those things that kind of get your little singles, doubles, or just whenever you call it foul balls, you're not striking out in the fund, those don't do shit. Those just keep us on par for the Southeast's undervaluation. We've got to shove a couple of these further. Yeah. And everyone has to, but we're doubly incentive because that's when we'll get our Southeast premium if we can get them a little bit farther. So that's just, it's an interesting, whether it's true or not. I don't know if it's that, again, quantitatively provable, but it's a good construct to look at, or a lens to see this through, because we need more to go further to get.
Sure. I mean, and listen, it's always a dangerous game to be talking oh, this time is different, right? In most scenarios in the financial markets, that's a dangerous thing to say. But you think about just the maturation over the last decade in the entrepreneurial ecosystems of the Southeast. There's no way to compare what we are now versus what the region was 10 years ago. Right. Those flywheels have been spinning and they change things. And I love the triangle and I think we're doing awesome, but we're not the only one. What's going on in Nashville and Chattanooga and Atlanta, Orlando and Tampa and Charleston. I mean, there's a lot of places across the Southeast that over the last decade have become real little tech hubs creating, great businesses. And it was so much more one-off just 10 years ago in this. And it's, capital is only one piece of that. It's the broader kind of entrepreneurial ecosystem, and a lot of different players, play in that. And people have learned over time and mimicked other markets and know how to, be at the universities or groups like CED or, all the different players that go in to better the overall ecosystem. Everybody's playing the game a lot better. And, here in the Triangle, we're a great example of it. And I think that at the end of the day is what brings companies up through that, from idea to seed investment to eventually some kind of exit, how those early entry points that are at a lower price become more, higher returns at the end of the day. And then bringing, there's also no way, even 2 years ago to think about the flattening of this world of the Zoom world, helps tremendously of being able to get these companies funded by a larger group of investors once they hit certain points. And, I think that in the ecosystem, people are doing a lot better about trying to bring those different partners into market too. For instance, some of the growth equity, funds that we work with and try to get people on their radar earlier and earlier so that as they kind of grow up, they'll already know them and it'll be an easier decision if they want to back them. And that's something that we try to do as a fund, but that's also something that Hunter at CED CD tries to do, right? Like bringing investors into like the fly-in event and things like that, to where like they're familiar with these startups in the ecosystem. So when it comes time that they're actually, out there raising money, it's not a new idea. Cause like that can't be overestimated, like of how important of like already knowing a business, knowing an entrepreneur, knowing other people that know them. It's just like, it's so many different ways of de-risking an investment, all kind of wrapped up into that. And so like, just having those relationships, be it through Zoom or be it through flying events or being it through a fund like us that's been kind of putting these companies in front of you so you can get familiar, like all of that stuff, it works towards what you were talking about of like down the road, better rounds and better exits for the businesses that, grow up around here and in other pockets throughout the Southeast.
Yep. And even something that came to mind is just more, qualified board members too, right? Because I left to join boards, but I was like, wait a minute, I don't have this pipeline. We need more board members that have pipelines to all these other investment vehicles so that they can be the ones pulling, because the entrepreneur still has to operate the business. They can't be like also, and they should be still fundraising at all times, but like, if someone can really be like, I got to get you up to Boston, I got to get you to New York, I got to get you to San Francisco, they can really drag them through. So that's interesting. So that's
a great point. It was, I meant to mention it when in my answer just now, because like that brings on just like the people, like change that we've seen. I mean, it's obviously skyrocketed during COVID, but it was something going on long before that. Like serial entrepreneurs moving down into the Triangle and to other places, in the Southeast and across the Sun Belt, right? Like just people moving out of money centers and moving out of the Valley and doing their second and third and fourth startups here versus wherever they work. Like that also can't be overestimated of how important that is. An entrepreneur, their third or fourth time through is much higher likely of success. And, not that long ago, it was really tough for those entrepreneurs to move into a region like ours and feel confident that they can build the startup in an ecosystem that's going to be supportive of it. And that's just not the reality anymore. I mean, like many entrepreneurs view it as easier and definitely cheaper, to build that business. And so, that's a genie that can't be put back in the bottle either, right? Like that will forever be different. And that all like lends to better returns on, investing in startups in this region than if you were trying to do the same thing 10 years ago.
Sure. Yeah. And even the fact that I said board members was the first thing that came to mind would not have been what came to people's mind 10 years ago. It was like, anyone with any experience as an entrepreneur or engineers or whatever. And then it kind of became like management teams. And then it's like, so it's evolving over time. So I guess to that end, what are you thinking about for the next 10 years, which is a big window, obviously, but how do you see our ecosystem call it Southeast, and as well as Front Porch Capital kind of evolving over kind of that big long time?
Right. Yeah. I mean, it's the time frame that we have to think about as a fund, because right, like our funds are those decade-long funds, and you need to think about what you expect to happen over time. Over the next decade, I mean, we're, as I said, big believers in the Southeast and a bunch of different ecosystems getting stronger and stronger. What I see happening, and, I see it today and I see it continuing to happen in the future, is are the different ecosystems across the Southeast working better and better with each other. Whereas it was always a little siloed. And over time, like investors in Atlanta are spending more time in North Carolina and vice versa, right? And like everybody's going to venture Atlanta now. Like we're going to see a bunch of people down in Dig South and Charleston later this week. And just like, I don't think any one geography in the Southeast can compete against New York or the Valley like on their own. And I think everybody recognizes that. But collectively, as the Southeast, and being able to kind of share deal flow, split up checks, club deal on various things, like I think the Southeast as a whole can compete and will compete more and more against the Valley and against New York and against Boston. And so I think that'll be a big change. I think also just like we've seen it over the last couple of years, but just like the number of funds being launched in the Southeast is just really strong, and will continue like to happen. And some of them will be spinning out from larger funds that exist. Some, I know multiple. One of the guys, Peter, like on the panel that I'm speaking on at Dig South, like he moved from LA to set up his fund in New Orleans. He's been in, a VC out in California for most of his career, but he's originally from Arkansas. His wife's from Louisiana. During COVID, they moved to New Orleans. He's never lived there, and he set up his fund there. And you see more and more of that. And that changes the landscape of venture across the Southeast and makes it stronger. People like Peter and others that are doing similar things. And so I think that'll be a big story. As well as just kind of, funds that are playing to the strengths of the Southeast, diversity being one of them. Black-led funds, investing in Black-led businesses. I think, we are seeing, strong growth in that in the Southeast, stronger than other regions. And I think we'll continue to do so, as well as female-led funds. And so, those are things I get excited about thinking about over the next decade, what it's going to look like.
Yeah, that's great. That's a great answer. I mean, I think, it's always kind of a balance between keep your head down and grind it out. And, each day, each email, each phone call, each meeting is really the next best thing you can do versus always chasing that big vision. But like everyone has to get their arms around something that's bigger to help pull them through, right? And get excited about something. And I do want to see this ecosystem. I mean, I guess at this point, I've been a part of like the Southeast tech ecosystem for 10 or 15 years, almost 15 years. So I'll be kind of rounding out the second decade soon. But each time, I mean, like you don't get as much done as you think in 1 year, but you get way more done in 10. Concept is very true. And I totally botched that quote. But the point being, like, you're like 10 years, like, damn, I was like nowhere. I mean, I didn't have anything. I didn't have this business or that business. Or, I mean, for me 10 years ago, well, a couple of years ago, well, my oldest turned 11, but when I asked myself a couple of years ago, I didn't have any kids. Like, oh my God, like, what was life like? But anyway, yeah, I know, like, what was sleeping in like? But that's great. And then we're close to time, but how you maybe have the good fortune of not having to answer this question a lot because you do fund to funds kind of stuff. But like, we still have a problem in our area with companies getting started, right? And some of those things in the 10 years, meaning like before they can even get to a venture capital, management team, product market fit, all that takes cash, takes money, takes sales, which sales takes products take development time, engineering, whatever. And while I actually totally love that vision of like the Southeast being more interconnected, and like we had a 2-year break with COVID maybe, so we kind of maybe took a couple steps back, but like some of these events being really marquee for the region, not just, echo chambers of your own little town. That's awesome. Like I'd love to see that. I think it's a great idea and a great concept. And just because there's going to be more winners overall, because we're not all kind of fighting for the same things, and which then will uplift the whole, rising tide. But that doesn't mean that it's going to be any easier. And not that it is in the San Franciscos or the New Yorks, but like when more bad ideas get funded, that also just means more ideas are getting funded. So how do you, if someone's just like, okay, I have a startup, I need investment. You're like, you've got 5 other steps, if not 500 steps to go first. How do those folks get started? How do you think about that gap from just like getting off the ground with anything? Is that, family, friends, or how do you kind of look at that?
Yeah. I mean, there's definitely no silver bullet on that one, right? Like like you are absolutely right. Like if bad ideas are getting funded, that does mean more things are getting funded. And so there's more capital out there. But I think we have to approach it from a bunch of different perspectives. I do think like the grants and things from CED and other things are an important part of the ecosystem. I hope they continue to grow that program because it pushes more people into going out and starting that business. The reality is like most businesses, most startups do get started with either kind of personal capital, being able to bootstrap for a little bit, at least to get a concept going, or like a friends and family round to give you a little bit of money. That's particularly a disadvantage for a lot of minority groups that have, statistically just shown like the inability to actually raise that kind of friends and family round, and has like locked out a large group of people from it. And something that we need more kind of concerted effort on, like putting money in that. And thankfully there have been a lot of different, both funds and programs to be able to kind of to attack that specific problem. And I'm the first part of fixing a problem is like everybody recognizing it exists, right? And I think that has become like more in the conscience of people, over the last several years. And I think that's a great first step. And we just kind of continue, creating more programs, funding more of those programs. I think the crowdsourcing part of the world plays a huge role in that as well. As like, you don't necessarily have to have friends and family that can support you. Like you've got to be able to convince a crowd, of something. And, that's going to work better for some ideas than others. But I think that's like the main point here. It's like there's more avenues for people to go down to try to do that now than there were just 5 years ago. And I think that continues because people recognize how important, starting businesses are. And I don't know, there's just something like on a human level engaging about it, right? Like of like contributing to someone's business that they're starting that, could create jobs and wealth and happiness, like in your community, or more broadly in your region. And I think people recognize that more, now than 10 years ago. And that's why we see more and more money going into these different channels to do that.
Yep. Yeah. So that's another great answer. And there is no one solution. It's leveraging community resources, whether you're at a university or community college or grant programs or mentorship networks or just going out like, I mean, and I like both of these tracks. One is, seeing this mesh network of the Southeast kind of just continue to grow and rise. And the more connected and interconnected that is, the more, we might see a bigger, kind of that next like leap forward, right? Not just another, incremental step, but a little bit of like a geometric pop. But then on that 0 to 1 in Peter Thiel terms, because 1 is very far, but like the 0 to 0.1, just working as a kind of community to figure that out and seeing a lot of different people taking stabs at it, and everything is kind of good, meaning if we're like identifying it as an issue, because it's an issue, like, I mean, it's always has been. It's always been like, man, like it's, it's hard to just get access to that first like little bit and to even have the network to know what to do, even if you could get it. But I think, I don't know. I know things that kind of come to my mind are things that I'm interested in and talking about and actively pursuing. And one is just like conversations around like micro lending, which, Alexa or, my phone picked up or something. So now I'm seeing a lot of ads for it. And I'm getting articles about how it's actually been like very bad in certain developing nations because it was supposed to be this big deal. And it's actually people are just cranking out the interest and it's turning into payday loans, which is bad. But, there's good research that apply well.
In line between those two things.
That's right.
The payday loans and the micro, and it's tough. And there's word of some regulation that may be coming through this Congress that is going to significantly change that landscape.
Sure. I think there's definitely a way to do it the right way. I think administered the right way, where it's not about an outsized interest payment. It's more about like, it's small enough to where it's just some interest, but you're really actually encouraging people to participate in the investment landscape into local, small businesses and that job creation. And maybe the upside is it's a small pop of equity or something as a bonus or as a convertible or something, not even to get into but basically non-predatory way to create small amounts of capital for small businesses that need it. And then also you've seen the rise of kind of like the venture studio model, right? Which is something I'm sort of tinkering around with. Either going to be a one-off basis or is it going to be more of a professionalized thing? But those are just access to more resources and more people that can go out and work on problems. And
I think angel groups also play a big
angel groups, yeah.
Like, and there's different kinds of angels, right? Like, there's a lot of people think about angel investors, like the big ones being like Silicon Valley people that have made a bunch of money on whatever they started and invest fairly large sums in other startups around the region, and that has played a huge part in the ecosystem. But that's only like one idea of angel. And in the Southeast, it's usually more kind of local business people getting together and wanting to invest. And we've seen more and more of those pop up. I mean, like, for instance, a year ago, at least to my knowledge, like there wasn't an angel group in Winston-Salem. Like now there is, and like they only invest in businesses that are being started in Winston-Salem. And that like hyper local angel groups across the country, across the region is really important in terms of getting local businesses off the ground. Because I mean, like as while the Triangle may be underfunded versus New York, like it's much easier to start a business here than it is most of the rest of the North Carolina, right? And so like these local angel groups, in different places play a huge role and will play more and more of a role. And it's great to see like just successful people willing to put their capital at risk to come into early stage businesses, that are rising in Winston-Salem or wherever, right? And that's what you want to see more of for a healthy ecosystem, and we are seeing that.
Well, all right. Well, I think we're at time. So, I mean, this was a great conversation. We could go all day talking about this and finding, pulling at threads and seeing where our biggest challenges are and also our biggest opportunities. But I think this was definitely a good starting point. So, Greg, thank you for joining and sharing all this knowledge and wisdom. And obviously, best of luck to you and to Front Porch Capital. I'll be cheering you guys on as not only investors and ecosystem builders, but innovators sort of in our market. And you're taking a big step towards, fulfilling that 10-year vision that you laid out, which is, the Southeast is going to be more interconnected, and we're going to see more kind of communication and collaboration between kind of markets, and your model sort of promotes that. So that's awesome. Thank you. Congrats. Keep going. And man, any final closing remarks? You have the floor.
Yeah, no, just thank you for having me on here. As always, it's great to speak to you. And always want to be talking about this, right? Like more startups doing better, ecosystem growing and maturing, here in the Triangle and Southeast. And I think that me and you kind of share a similar view of like it's exciting. The next 10 years is going to be exciting. And it's going to be, it's going to be awesome working in it and watching people grow their businesses and be successful.
That's right. Awesome. Good final wrap up. This, because it takes me a long time to make these into real things, it will not go live by the time of Dig South. I'll be there. So what day is your talk or panel time?
It's Friday morning. I think 9:30, something like that.
Okay.
I mean, it's actually, it actually is, the name of the panel is something about like the capital landscape of the Southeast. It's actually right around what we're talking about right now. So it'll be interesting. It'll be, some different perspectives, on that.
Okay. That's great. Well, I'll try to go. I'm not trying, I have to be back at some time Friday, but I'll try to squeeze that one in. But I think I'm Thursday at 3 or 3:15. And I think it's the talent landscape, which is another thing that everybody's facing everywhere.
Which will make yours as well. Yeah.
Yeah, that's right. Like, do you have the answer? No.
We can go 3 hours talking this out.
That's right. That's right. Well, okay. Well, I mean, if I don't see you in the Triangle the next day or two, I'll see you in Charleston later this week.